Assalamu alaikum everybody. Today's topic is bank reconciliation statements, and a lot of students have actually requested me to make videos on bank reconciliation statements. So the basic thing about bank reconciliation is that we need to understand that the bank balance that we calculate and the bank balance that the bank calculates, it's different. So that is why we are making bank reconciliation statement. So if it basically does not apply to real world scenarios right now, because the thing is that whenever we are doing any bank transactions these days, we immediately get a message, right? So let's say I'm spending some money from my bank, or using my card somewhere, or using my debit card somewhere, or I am spending money through online banking, or it's any kind of transaction. I'll get a message from my bank saying that this much amount has been deducted because of my transaction, or some, let's say there's some incoming in my account, so there's some incoming of money in my account, and that is also going to be told to me through a message. So that is why we don't need bank reconciliation statements these days, because bank reconciliation statements is a topic of that time which when we did not have any messages. So the bank would not contact the customer on a daily basis, but the bank would send the bank statement on a monthly basis. So the bank statement is a statement of account that the bank is producing for us, and that is our business bank account. So it's like the bank will record everything that is coming in our bank account, and the bank will also record everything that is going out of the bank account. And for the cash book is our record of our bank transactions. So whatever money we are receiving, whatever money we are paying out. So let's say we are not in contact with the bank on a daily basis, then there will obviously be some differences. So there will be some things which the bank did not record, and we recorded those, and there will be some things which we did not record and the bank recorded those. So because we were not in contact with the bank on a daily basis like we are today, we did not record those things which the bank recorded. So we need to understand this, that our business bank account, so cash book has two columns. One is the cash column and the other is the bank column. So we'll only be talking about the bank columns in the case of bank reconciliation statements. So the bank column of our cash book is obviously it increases on the debit side and decreases on the credit side. Everybody knows that, because the bank account of the business is an asset for the business. So assets increase on the debit side, decrease on the credit side. And what we need to understand is that a debit balance in our cash book, a debit balance is a positive balance. Whereas a credit balance in our cash book, so cash book bank columns, if it's a credit balance, it's a negative balance. So we all know the concept of overdraft. The concept of overdraft is that I exceed the amount of money that is available in my bank. So let's say there's $10,000 in my bank, but I spend more than $10,000. So that means my account will go in negative. So that is a bank overdraft, and it's a negative balance. Okay. For the bank's perspective, you guys need to understand this, that for the bank, our business account is a liability, because I can any day go to the bank and ask for the money, or take it out anytime, because that's my money. That's not the bank's money, but the bank is keeping it for me. They're keeping it safe. So the bank account, the business bank account, is a liability for the bank. So we need to understand that the business, from the bank's perspective, it increases on the credit side as liabilities increase on the credit side, and decreases on the debit side. So whenever we are spending money, the bank will debit our account in the bank statement. Whenever we are receiving money, the bank will credit our account in the bank statement. So interestingly, if you guys have used a debit card, or for payment, let's say, so whenever we use a debit card for making a payment at a store or something, we immediately get a message, your account has been debited. That means your account, the balance has been deducted from your account. Similarly, whenever there's month end and I receive my salary, the message that I get is that your account has been credited by so and so amount, and that means the balance has increased. So the for the bank, our account is a liability, and our business account is basically a liability, and it increases on the credit side and decreases on the debit side. So that means a credit balance on the bank statement is a positive balance. So a credit balance on the bank statement and a debit balance on the bank statement is a negative balance. So debit balance on the bank statement is a negative balance. So this thing is very important for solving the questions and understanding them. So we move on to the items that which are not recorded in the cash book. So whenever the month ends and we receive the bank statement, so whenever we'll see the bank statement, we'll see certain items which the bank has recorded, but we did not record them because we did not know about them. Because again, you guys should know we are not this topic is not of today's age. It's of some many years back when we did not receive messages, maybe my childhood. So it's a topic of my childhood when we do not receive messages for the bank transactions immediately. So then we'll just study what each item here. One is bank charges and bank interest. So you guys should know that bank charges is a cost of running the account. So for example, any service charges, any so if the bank is maintaining the business account, so they will definitely charge some money, so that it's like a service charge. So that is how banks earn also. So that is one sort of charges which the bank, which the cash book is not, which are not recorded in cash book. So what you need to do is that whenever you will have to make the updated cash book. So on the side I've written here that you need to record these in the updated cash book. So we need to update the cash book. So what we'll do is that bank charges will obviously come on the credit side of the cash book, because on the credit side the amount is reduced. So whenever we are paying something, so bank charges we are paying to the bank, so amount is being reduced in that case, and bank charges will be obviously shown on the debit column in the bank statement. But we need to record this on the credit side of the cash book because bank charges are reducing our bank balance. So bank interest, again, interest charged on loan or on overdraft, is also going to reduce our balance, and we will credit this because the bank actually directly deducts the bank charges and bank interest. Then we have dishonored checks. So dishonored checks are that checks which are returned by the bank. So let's say my customer gave me a check, and my customer's name is Mr. A. So Mr. A gave me a check. When I received a check from Mr. A, what I'll do is that I will debit my cash book. So I will do bank debit in my cash book on the debit side in the bank column. I'll do bank debit. I'll do Mr. A credit. So Mr. A will be credited, and I'll basically record the amount as well. But let's say the Mr. A does not have sufficient balance in his bank account. So what the bank will do is that the bank will return the check, and that will be a dishonored check. So what will happen is that you need to basically update the cash book and record this on the credit side, because when we received the check we debited the cash book, right? So when we get to know about the dishonored check, the same check we haven't received, so you need to credit the cash book so that that amount is removed from the debit side. So because the cash book increases on the debit side, decreases on the credit side, so we increase the amount. Now we'll decrease the amount so that the amount goes to zero, because we haven't received the money from Mr. A. So dishonored checks are recorded on the credit side of the bank columns of the cash book. So this check is basically going to be recorded on the credit side. Then we have amounts paid by the bank to others. So there are three types of banking transactions that the business can undertake. One is a standing order is I am instructing my bank. So let's say I tell my bank to pay my rent every month on the 15th of every month. So that means it's a 1 month interval. So the interval is it's like a fixed interval, and the amount is also fixed in that case. So in standing order, it's a fixed amount and fixed intervals, and if the bank is making a payment for on the behalf of the business, so you need to update the cash book and record this on the credit side of the cash book. Again, direct debits is also similar to standing order, but in case of direct debits, the amount and interval is not fixed. So the amount is not fixed and the intervals is not fixed. So let's say I tell my bank to pay my electricity bills or pay any other bills of mine. So my bills will obviously be different. So and the date of paying will also be different. So the bank will pay on my behalf. So if the bank does that, you need to again credit this in the updated cash book. And credit transfer. So if the bank is transferring money to someone from our account to some other account, so it's again a payment. So you record this on the credit side of the updated cash book. Then we have amounts paid into the bank, our bank, by others. So let's say others are paying us. So let's say if we are receiving a credit transfer, that means my customer is directly paying in my account. So I need to record this on the debit side of the updated cash book because this will increase my balance. I'm receiving money in this case. Then we have if it's a standing order, so someone is paying us fixed amount at fixed intervals, again you need to debit this. If it's a standing order, you need to again debit it if we are on the receiving end. And if it's a direct debit again, so if it's a direct debit and if we are on the receiving end, we will debit this in the updated cash book. So normally you will see in the questions, standing orders are usually in payments and credit transfers are usually when you're receiving money from your customer. So you need to read very carefully if you're receiving a credit transfer or if you're paying a credit transfer. Okay, then we have any errors in the cash book should be corrected in the updated cash book. So let's say the business mistakenly over added the debit side. So let's say we over added the debit side by $100. So that means the debit side is heavy and it's an error, right? So what we'll do is that we will record this on the credit side of the cash book, updated cash book, and we'll write error and we will write $100 on the credit side, on the credit side of the cash book. So you need to look at the error and accordingly correct it. So let's say if there is an insurance payment which we have recorded twice in the cash book, so we have actually credited the cash book twice with the insurance payment. So now what you'll do is that you will debit it once. So that let's say it was an insurance payment of 320, so we recorded 320 and 320 twice on the credit side. So we will debit the cash book by 320 so that the error is removed, because we did not have to record it twice, we had to record it once only. So then we have another part of this chapter, that is items that are recorded by the business in the cash book. So something that we have recorded in the cash book and the bank statement does not show that. So let's say it's an unpresented check. So unpresented checks are payments. So it's a payment that let's say I made to someone. So my supplier, I made a payment to my supplier and I gave them a check. So the moment I gave them a check, I recorded that on the credit side of my cash book. But what happened was that my supplier was too lazy to go and put that check in his own bank. So that means now the bank does not know that they have to reduce the amount that is available in the bank, because my supplier did not go and put that check into his own bank. So that means amount is not transferred from my account to my supplier's account. Another thing is that let's say I made a payment to my supplier or to anybody, and there is this 3-day clearing time. So there is this thing called in banking, it's called clearing. Let's say I'll give you an example. There are two different types of banks. So there are two different banks. So one is, let's say I live in Karachi, so I'll give you Karachi examples. So one is, let's say, Habib Bank, and the other is, let's say, HBL. So HBL and Habib Bank are two different banks. So let's say I am giving my supplier a check of Habib Bank, and my supplier has his own bank account in HBL. So what will happen is that when my supplier puts that check in HBL as a payment that I have made to him, what will happen is that it will take 3 days to transfer, 3 working days. So sometimes it does not take that long, but let's say it's the maximum time is 3 working days to clear. So it'll take working days to like uh, to transfer from my bank, that is Habib Bank, to HPL. So in that time, if the bank statement is printed, so obviously that will not show that payment. That bank statement will not show the payment that I made to my supplier in HBL, let's say. So 3 day is the clearing time, and unpresented checks are payments. So you guys should know these are unpresented, and unpresented are payments. You guys should remember this. Unpresented are payments, and then we have uncredited checks or deposits. These are which we receive. So we receive uncredited. इसको क्यों कहते हैं? Why do we call them uncredited? Uncredited because whenever we are receiving money, right? So in the from the perspective of the bank, whenever we are receiving money, the bank is supposed to credit our account, but uncredited means my account has not been credited by these checks. So when I, let's say, receive a check from my customer, I directly recorded that in my cash book on the debit side, but in the bank statement it does not appear. So why does it not appear in the bank statement? Again, clearing time. So let's say I have put that check into my bank, but the clearing time takes time, and during that, if the bank statement is printed, I will not see that balance increased in the bank statement. So these are uncredited checks. So uncredited checks are something that we have received, these checks, and these are supposed to increase the bank statement balance, and these unpresented checks are going to decrease bank statement balance. And then, okay, very important, super important for today's video is to make how to make a bank reconciliation. So there is one thing called updated cash book. So we are going to update the cash book with items which are recorded in the bank statement but not in the cash book. Okay, so we need to update the cash book for those. And then we have this format of bank reconciliation in which we are going to update the bank balance. So we will start with balance as per bank statement. So what is our balance in the bank statement? We'll take that, and then we'll do add uncredited checks, because uncredited checks is going to increase the amount of the bank statement balance. And we'll then subtract unpresented checks, because unpresented checks are payments, and we are going to subtract, they are going to decrease our bank balance. And then what we'll get is balance as per updated cash book. So the balance we took out in the updated cash book, and this should match in the end. And if they don't match, then that means we haven't done the bank reconciliation correctly. Also, in some cases this is unknown, so I'm just going to highlight this balance as per bank statement is unknown, we don't know it. So it's fine, whatever we balance we take out from the updated cash book, we will record that in place of the updated cash book. We will assume this to be X. So in that case, you need to go backwards. So when you go backwards, so what you do is that you start with balance as per updated cash book in your calculator. So in your calculator, you'll write this balance first, balance as per updated cash book. Then what you'll do is what you are subtracting in this straight method, when you were starting with balance as per bank statement. So I was subtracting unpresented checks, but then I will add unpresented checks because I'm going backwards. So now what you will do is, normally what is subtracted, you will add unpresented checks, and then what you will normally, what is added, you will subtract that. So that will be less uncredited checks, and then you will get your balance as per bank statement. So that is another format. I will write it for you guys. Always when you look at the marking scheme, you will actually realize that they have done it in two presentations. So this is the other presentation, balance as per updated cash book. We'll start with balance as per updated cash book. Add unpresented checks. Less uncredited checks. So yes, so we'll start with balance as per updated cash books, which we have taken out from the updated cash book. we will add unpresented checks, and then we less uncredited checks, so we'll get our balance as per bank statement. So sometimes bank statement balance will not be mentioned in the question, so you don't have to worry. You can take this formula which I have given you, balance as per bank statement. It starts with balance as per bank statement and assume balance as per bank statement to be X, and what you do is that then you backwards calculate. So you can either remember one format for bank reconciliation, which is the easier format as balance as per bank statement, add uncredited checks because those we have received, and less unpresented checks because those payments we have made, because those are going out of the bank, they are supposed to deduct our bank balance, and then we'll get balance as per updated cash book. Also, one more thing, if there is an error on the bank statement, you need to correct that in the bank reconciliation, because in the bank reconciliation statement you are correcting the bank balance, in the updated cash book you are correcting the cash book balance, in the bank reconciliation statement you are correcting the bank balance. Okay, so that is done for this video. These were the basic concepts of bank reconciliation, which I teach normally in my class as well. So thank you so much for watching.